In this video clip, we now move to step 3 of the NCI calculation. We're still using question 1811, one of the tutorial questions, and we now look at the change in equity of the subsidiary in the current period. The NCIs are entitled to their proportion of those changes. So, for example, if you've got NCIs of 25%, then any changes in the equity of the subsidiary, 25% of that we have to extract and disclose separately as part of our NCIs. Now, in the previous two videos, we've already seen that we calculate a basis value for our NCI on acquisition date, and that adjustment entry that we pass every year stays the same. There's no adjustment for any later on decisions that result or relate to pre-acquisition equity. Then we've covered the second step, which is any changes in these equity balances or new balances that is created in the period since acquisition date until the beginning of the current financial year. This NCI share of the changes in these equity balances are once again extracted from those equity accounts and disclosed separately as NCIs. Okay, so now we look at the accounting transactions in the current financial year. On the screen you now have the NCI adjustments relating to transactions that affect the equity of the subsidiary in the current financial year. The first one is to extract the NCI's portion of the profit reported by the subsidiary for the current year. From the financial information, we saw that the profit of the subsidiary for the year was $15,600, and the NCIs are entitled to 25% of that. But before we calculate their share of the profit, we first have to consider any of the BCVR or other consolidating adjusting entries that affects the earnings reported by the subsidiary in the current year. Now, the only thing that we have to consider is the extra depreciation expense for 6 months and the write-off of the undepreciated part or portion of the machinery when the machinery was sold. We also have to consider the tax effect of those two entries. So the net adjustment is then made to the profits, and then 25% is extracted from the profits or the retained earnings and allocated to a separate line item NCI. So that is disclosed separately in the equity of the group. So we'll see a line item in the statement of changes in equity on the and in the statement of financial position of the in the consolidated financials of the group, which states NCI. The second thing that occurred in the current year is that a transfer was made from retained earnings to general reserve to the amount of $1,000. Now, this transfer to general reserve was made out of pre-acquisition equity, and when we looked at the pre-acquisition equity elimination entry for the parent, we dealt with the parent share in that entry, because for the parent we are concerned whether it's pre-acquisition or post-acquisition earnings. But for the NCI, we don't look at that distinction, and we only work with the timing of the transaction. So in the current year, so we make the adjustment for the NCIs in the current year. Now, this is actually a combination of two entries. The net effect of it is 0 on the NCI, so that's why it's combined into one. But if we split it out, we basically see that the general reserve increased by $1,000 with that transfer. So we'll debit, I'm sorry, just get my pen again. We'll debit the general reserve with, so we're extracting it from that increase, 25% of that increase from the general reserve, and we not reclassify it, but disclose it separately as part of our NCIs. So because there was an increase in the general reserve, we have to see an increase in the NCI for their portion. So we take it from the general reserve line item, disclose it separately as NCI. The other part to that is a reduction in retained earnings because it was transferred from retained earnings. So there's a reduction in retained earnings. So therefore, we have to record a decrease in the NCI. So we'll say debit NCI, credit retained earnings. So to allocate that decrease in retained earnings to the NCIs. So these two have a null effect, and we can combine it in one adjustment. The second thing that occurred was the asset revaluation surplus. So there was an increase in the asset revaluation surplus of $500. So therefore, there should be an increase in the NCI of 25% of the 500. So therefore, we credit the NCI and we debit the asset revaluation surplus because we extract it from the asset revaluation surplus and disclose it separately as part of the NCI. The next entry on the screen relates to the machinery that was sold. Once again, for the parent, it's dealt with in terms of the pre-acquisition equity. For the NCI, it's dealt with in the time period to which the transaction was occurred. So that happened in the current year. And that's the balance of the BCVR that is transferred from the BCVR to the retained earnings. So we just pass the rest of that. The last two transactions for the current year relates to the dividend that was paid, the interim dividend, and the final dividend declared. Now, any dividends paid and declared represents a reduction in the equity of a shareholder because it's a distribution of equity to the shareholder. So as the dividend is paid, the NCI has to reduce. As the dividend is declared, same principle, the NCI has to be reduced, and it's 25% of whatever dividend figure we're working with. The balance of these dividend accounts will be dealt with in our normal inter-group consolidation adjusting entries, where we eliminate any intercompany balances owed and due between companies within the group, and we reverse the dividend paid against the dividend revenue recorded in the parent company.